People think of software as naturally scalable and naturally what's going to create a great business. But language, at a general level, is the ultimate scalable thing of how it brings humans together, how it gets people to work together. And I would just think of taking the time to write down your cultural values or write down your operating principles. You're writing the software for how the team works together. You're writing the software that is going to attract the best team to come and work for you. And it's this ultimate software that gets a company to move really quickly and gets a company to build something special.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 159 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors, and operators to unpack their journey, lessons, and insights to help current and future entrepreneurs. The voice you heard a little bit earlier was that of Niki Scevak, the co-founder and general partner of Blackbird Ventures, and our guest for this episode. Blackbird Ventures is one of Australia's leading VC funds, counting a portfolio including the likes of Canva, Safety Culture, and Culture Amp, just to name a few. In this interview, we covered the story behind how Niki and Rick Baker first came together to launch Blackbird Ventures, how the power law shapes Blackbird's investment philosophy, and how their own approach to raising the ambition for their portfolio led them to shift their own strategy from building the Craigslist of VC funds to growing from 4 to 60 people and raising Australia's first $1 billion fund. Speaking of raising ambitions, for those of you that follow me on social media may know, I recently left my role at AWS to focus full-time on the podcast and spend more time investing in startups. More on the latter in a future episode of the podcast, but in the meantime, I'm excited to spend all of my energy in creating more podcasts and more content around the show. As you'll hear through this podcast, one of the things that Niki mentions as a key marker of success is having the right team around you. And I'm excited to share some new partners of the show that will hopefully help you on your journey as well. I remember when I was running my first startup stage label and we were quoted 50% of our friends and family round by a traditional law firm to set up our legal infrastructure. Absolutely ridiculous. When you're just starting out, you need to have the right advice at the right time and done in a founder-friendly way, and that's why I'm so excited to be partnering with LawPath. LawPath is an Australian startup that is Australia's largest online legal platform for businesses and individuals. LawPath's legal advice plan gives you access to lawyers on demand for one low monthly fee. Through their platform, you can go online to create documents, sign online, and even have a lawyer on call to help with any legal issues at a fraction of the cost. In fact, they've saved Australian businesses over $100 million in legal fees and are offering Startup Playbook listeners 20% off their most popular plans. To get access to this offer, head over to lawpath.com/startupplaybook to access this exclusive discount. And for those of you that are regular listeners of the show may recall, in episode 132, I sat down with Guy Pearson, who not only co-founded and is the CEO of Ignition, which last year completed their $65 million Series C funding round, but he also founded an accounting firm called Sender, formerly known as Interactive Accounting. Since then, I've moved all of my personal and business accounting over to them and can say from first-hand experience that Gareth, Charlotte, and the team at Sender are more than just an accounting firm. They have a dedicated focus on founders, funders, and startups and can help you with everything from managing your tax, helping you with your exit strategy, or even setting up investment vehicles. To find out more, head over to sender.com. And finally, one of the most common questions that I get asked by startup founders who haven't had the good fortune of finding a technical co-founder is who they should go and speak to help with their product development. And the first place that I always send them is my friends at Dovetail Studios. Not only are they an extremely experienced product development partner that has built products for the likes of Afterpay, but they also have a $10 million fund called Dovetail Capital that invests in early stage ideas. So if you're a non-technical founder looking for capital and to have the right development team around you, go and check out dovetailstudios.com. Okay, with that out of the way and without further ado, here is my interview with Niki Scevak. Hi, Niki. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Thank you for having me.
Niki, I'm sure that most people, especially in the Australian startup ecosystem, would be very familiar with you, but for those listeners that maybe aren't as familiar with your story, do you want to share a little bit about your background and what got you here today?
Sure. I founded 2 startups after university. The first one happened while I was at university and was most famous for the person I founded it with rather than what the startup accomplished. I went to university with Mike Cannon-Brookes and a whole bunch of smart people. We decided to found a startup together, and I think that time, which was 1998, and the internet sort of commercial birth was really the awakening call for me to say this is what I want to do with my life and spend my career doing. I lived in America for a little more than 5 years, and then I moved back to Australia in 2009 and was looking to, I think, replicate the founder relationships I'd formed in the US, in Australia, and that led to Startmate. Startmate then led to Blackbird, and here I am today.
Yeah, absolutely fascinating journey. And just kind of touching on one of the things that you mentioned in terms of, prior to Blackbird and Startmate, you had been a founder, and one of those companies was with Mike and Brooks, who you went to university with. It's just been fascinating from the outside looking in terms of what you've built with both Startmate and Blackbird, and just the focus and emphasis that you have on the network effect that creates. I'm just curious to know from your own experience and perspective, how important was it to have someone like Mike and Brooks? I've also heard that the cohort in general was a really sort of fascinating group of people that you went to university with, and obviously the relationships that you built off the back of that. But how important was it for you to, I guess, be around those types of people to kind of help both sort of expand your own ambition and kind of help shape what you've built from there?
Absolutely crucial. I think the saying of you become the average of the 5 people that you spend the most time with is no truer than my own journey. And I was incredibly lucky to choose a university course where 40 of the smartest, most ambitious people had also chosen to do that same course. It was very improbable. It was sort of a mix of commerce and computer science, but had nothing entrepreneurial specifically about it. And it just turned out that there were probably 10 or 15 people out of that 40 that were super ambitious and incredible people and have gone on to their own successes in many different fields. And that was just the year of my university. All the years ahead and below have produced, again, all of these great founders and entrepreneurs and technology companies as well. So I think unless I was in that vicinity or in that geography with other smart and ambitious people, I don't think I would have succeeded, especially in my own personal journey.
Yeah, and obviously the landscape is so different now to what it was just a couple of years ago, and definitely to about a decade or so ago when you first launched Blackbird as well. I think the founding story of Blackbird has been sort of covered in a couple of different podcasts and sort of different content streams. I had Rick Baker on, your co-founder, on the podcast a little while ago as well. But I thought, one of the really sort of curious things as part of that, in doing research for this interview, I spoke to Rick again, was that, I think that people didn't realize that you and Rick weren't actually very close or weren't familiar with each other for that long before you both decided to start Blackbird. And obviously, one of the things that's often spoken about is the importance of having the right co-founders that are there, and the importance of that relationship. And again, speaking to Rick, he mentioned that both of you were initially looking at launching your own VC funds independently before you gave him a call and said, hey, what about us doing this together? A lot to kind of unpack there, but what were some of the things that kind of helped build conviction for you that it was worthwhile in you and Rick doing this together, and what did that process look like?
It was so serendipitous, as you described. I would also say that in 2012, the ecosystem was not an ecosystem. There weren't very many people who were passionate about Australian startups, and particularly, I think, Australian startups who were trying to be the best in the world. That segment of entrepreneurship was characterized by largely regionalizing successful US ideas. So you would take a business model that worked in the US and you'd make it work in Australia, Uber, Groupon, et cetera. And that was really the sum total of entrepreneurship in Australia. And I think there were surprisingly few people that had the dream that Australia could create global champion companies like Atlassian and so on and so forth. And so I would also note that there was just so few people who were passionate about that particular mission, and Rick and I were certainly two of them. We always the joke inside of Blackbird in terms of how we met. I was Niki with 2 Ks, and he was Richard rather than Rick, and just the serendipity of how it all came together. He was working with MLC. He was an LP of Silicon Valley venture funds and was based in the Bay Area, and was getting to know all of these emerging managers. And the initial hope I had was I was going to pitch Rick, and Rick hopefully was going to invest in the fund that I was hoping to set up. And in the first coffee meeting, he said, "I've got some great news. I'm going to leave MLC and I'm going to start my own venture fund." And of course, that was the beginnings of how it all came together. But I think like it was lucky in many respects, in terms of I think how complementary we are in working together. But I also think that the key was really that bedrock of shared beliefs and shared philosophy and shared like the no one was selling each other on the mission because we'd both independently come to I think the same driving force of what we wanted to do with our careers and the way in which we wanted to do it and the types of people in which we wanted to do it for. So I think that was almost serendipitous, was meeting someone who was so aligned on the vision of what we wanted to accomplish.
Rick also mentioned that you sent him to Mike Cannon-Brookes for a chat, and he wasn't sure whether that was a test or not. But flipping that a little bit for founders that are in a similar situation where they've potentially found someone who could be a co-founder in their business, but they haven't had that time to sort of build up that relationship or that sort of trust yet. Do you have any advice on ways that founders can kind of do their own sort of due diligence or ways that they can sort of speed up that process?
Yes, I think a decade on, there are great ways in which you can sort of work out if you'd work well with someone or it's worth giving it a shot together with. And we didn't have that a decade ago, but there's all sort of surveys or even workshops as to how you can draw out, again, that shared belief system or that shared values or the do you have the same vision? Would you work well together? There's like F4S is a great sort of personality test of you can sort of see how you'd work with teams and co-founders. Inside of Blackbird, all took the F4S personality tests, and sort of fingerprint for success is the is documented, and sort of you can see how you'd work well with someone or what traits you have that they don't have, or where you overlap, and how you might work together in a better way. I think there's a lot more science behind how people can work together. It was very unscientific in the beginning, but also say it was very low stakes. It wasn't, particularly grand. Startups were a forgotten corner of the Australian business world. Technology was not even popular at an overall level in Australia. And I think it just felt like, hey, let's give it a shot. Let's see if we work well together. And the work well together, I think, is best tested in those early days. Like you have to sort of run a gauntlet in the venture capital business. You're running the gauntlet of speaking to all of these investors and seeing if you can, in fact, even raise your first fund. In our first fundraising, the Australian government, there was a program to sort of match funds to your first fundraise. And the Australian government in this program said, we just don't think you guys will actually raise your fund. And it's unlikely that it will all come together. So we're not going to work with you via this program. So it was just, back then it was very unlikely that venture capital funds, even if they did want to raise a fund, would actually get raised. So I think, again, running that gauntlet, the relationship was really forged in those trips to Melbourne and trips to Silicon Valley and trips to pitching all of the Fund One LPs of Blackbird, and really brought us together. And again, sort of from a relationship standpoint, created that foundation that has been such a beautiful one for more than a decade now.
As you mentioned, very different landscape back then. Blackbird now has, I believe, over $10 billion under management across its 3 funds at the moment. 3 funds. Fourth, yes. And, I think it's fairly public knowledge that you're sort of currently raising for $1 billion or more, which is absolutely incredible considering 10 years ago, as you mentioned, it was a very, very different sort of landscape, and getting to, I think it was $29 million that was your first fund. And as Rick mentioned as well in our podcast interviews, there was a lot of no's that you went through. And, just thinking back to, I think it was the Sunrise Conference in New Zealand a couple of years ago, where I think for the first time I had heard Sam talk about Blackbird's principles. And one of the things that really sort of resonated with me was backing the hungry, not the proven. And I'm just curious in terms of, your own sort of experience that you've gone through over the last 10 years and, essentially being the hungry and not necessarily from a proven background in investments. How much has your sort of own experience led into both your principles with Blackbird, but also your sort of investment philosophy as well?
Definitely one and the same. I would say Blackbird is a triumph of the hungry, not the proven, even though we had achieved some level of success. Rick and I, before Blackbird, it wasn't anywhere near to the scale of a traditional sort of path into starting a venture capital firm like Andreessen Horowitz, or even locally with Airtree and Squarepeg and the founders' incredible accomplishments before founding the venture firm. Rick and I did not come from that scale of success. And so I think Blackbird as an example of the hungry, not the proven, and then just all of the investments we've made, if you just look at the world's most successful companies, if you thought, let's start a $1 trillion company and let's see how all the $1 trillion companies got started, they were all started by hungry, not proven people. In the case of Google, just finished university. In the case of Microsoft and Facebook, didn't even finish university. And so there is something about that hunger that drives these enormous successful outcomes, that sort of sense of having nothing to lose. I do recognize now, sort of 10 years, you instantly think of not losing something, and that almost holds you back from further success. This sort of defensive mindset and having something to lose is a blessing and a curse. And I think if you have nothing to lose, you just have that almost like pure achievement ahead of you, or there's just something special about that as a starting point. And I think if you look across the venture capital world or even the investment world, that first fund by a brand new manager always tends to have the greatest results, again, because I think that the hunger is at its highest peak. And I'm always paranoid about losing hunger, and as we succeed at Blackbird, not having that same level of hunger and ambition, and trying to always recharge, refresh, and re-raise our ambition over time as well.
I think a really interesting example of this was investment into Propeller Aero. So I spoke to Rory as part of the research process for this interview as well. And he mentioned that when you invested in Propeller, there was really nothing there. There wasn't a vision, a story, or any customers, but you still decided to invest in Rory and Francis back then. What are things that you look for when some of the more traditional markers, such as revenue or growth, aren't necessarily there, that makes you want to invest in particular founders?
I always say speed of learning. Like, are they going up a vertical learning curve? And a sort of good analogy in my mind is the sort of basics of high school physics that you learn. So if you think of like distance, velocity, and acceleration. Normally people just look at the distance, like how far has this person traveled in their career, and are they sort of traveled far enough to be able to start a company? And that, of course, you miss out on the sort of early career, no experience people, because they're just looking for distance. The velocity is how fast someone is learning, and that's a good predictor as well. But sometimes someone is maybe mid their career, they're learning fast, but the sort of they've worked their way up and they've hit this ceiling on the acceleration. The acceleration of their learning is zero because they've reached like a ceiling. It looks fast, but it's not quite super fast, versus the high acceleration. The rate of learning is growing faster and faster, and that, I think, looking for that acceleration. So even though the distance might be laughably small, even though the velocity might be still low and awkward, you're kind of watching a kid fall over and graze his or her knees, you can still see that huge acceleration in the learning. And then you just have to be patient enough to let that play out over enough time, such that that's when they become the great founders that are celebrated in the media and so on. But looking for that vertical learning curve and that super high acceleration in someone early in their career.
That's a really interesting point. I guess from a founder perspective, is there anything that they can do or a way that they can share their own velocity when they're speaking to investors for the first time, when, again, they potentially haven't launched or don't have customers or revenue in place?
In terms of just demonstrating that ability for them to learn, or sort of raising their chances of success with, say, a company or on the person or on the startup, would you say?
Yeah, so I guess from a one of the bits of feedback that I hear from a lot of founders is a lot of VCs say that it's never too early to come and speak to us, but we don't feel like we have enough in place for us to start those conversations or to meaningfully get us to a point where we can raise capital. So I guess the question is framed around what are indicators or ways that founders can get VCs interested when they potentially don't have those traditional metrics in place that would help them raise capital.
I think it is. It's a grand vision, and people, in my personal opinion, underestimate the value of a good idea. And the definition of a good idea for me is how deep the person has thought about that idea. And so everything sounds great in the first sentence of an idea, but does it sound great in the fourth or fifth meeting with the person discussing that idea? I think the good ideas, it's almost like the energy gets bigger and bigger as the person describes more and more of it, and the idea gets better and better. The second meeting is better than the first meeting, the third meeting is better than the second meeting, and sort of also I think because in a highly technical domain, technical founders are not known for their sort of um, charisma and sort of big selling. Oftentimes, it, like a good idea is drawn out because that technical person feels more comfortable in the details than they do at the high level, and so it's almost like they shine the further into the detail of the idea that you get, and sort of that shape of the second meeting being better than the first meeting, the third meeting being better than the second meeting, favors the sort of people with technical depth, or people with a sort of depth of thought around how an industry or how a problem should be solved and how the world should work differently. And so I think that great idea is underestimated. I think also the sort of person's journey to the idea. Why is that person connected to the idea? In the example of, say, Mel, who taught graphic design at university, then created Fusion Books, which was a high school yearbook business, then created Canva, or Luke Anir from Safety Culture, who was a workplace safety inspector. He, on behalf of the insurance companies, would have to go in and inspect what exactly went wrong in a workplace. And I think that journey of that person and their experience with the idea doesn't have to be through the product, or it doesn't have to be through the company, is incredibly important to assessing whether they have fresh ideas about how a problem should work, or how something in the world should work differently. And then, as I said, the distance will be incredibly small. The velocity will likely be low, but you're kind of looking for this micro glimmers of hope as to why the person is just iterating and moving really, really quickly, even if it seems laughable over a period of weeks, or even if it seems laughable over like an absolute level of progress. If you get a sense of the person iterating with speed, and the person being someone who doesn't complain about lack of money or lack of structure, just someone who is just going to do it and is just this breath of fresh air in terms of throwing everything at it. I think that's the clues that you should give them a swing at life, and you should go on a journey and see how it plays out, and sort of someone worth backing.
Absolutely. Something else that Rory mentioned as well was that alongside being a fearsome poker player, you were also someone that was a little bit scary, but really gave harsh truths to Rory, especially in the early days of Propeller as well. Specifically in terms of setting a set number of customers that he had to reach out or speak to each week. Again, really curious from your own perspective in terms of when you make that investment into a company and into a portfolio, how do you sort of balance leaning in and giving advice to founders versus letting them figure it out on their own?
I think people appreciate accountability, and as I said, they from this sort of coach role. The coach's job isn't to sort of tell someone to do it in a certain way, or like impose their viewpoints. It's almost like to push that person to the limits. And I think sort of the idea of getting the person to be the best version of themselves and pushing them to go beyond their sort of artificial boundaries in their mind into what their true achievements can unlock. You're sort of taking that mindset, and the way I think about it is you don't have to tell them what to do, but you ask them, what they would like to do. Like, I think, coming up with a sort of plan of attack and a framework as to how someone would measure whether they're successful or not, or whether they've made progress or not. I think in these incredibly, it's sort of, it is a technical skill in a lot of ways, where you have this big problem and you have to break it down into chunks and break it down into logical building blocks and so on. In a programming sense, you have to do that in a business sense as well. And so I think that exercise of helping someone break it down into a series of units of progress, and then once you have that, and once they're off to the races, then it's about holding up a mirror to themselves, more than again, imposing your own personal viewpoints. And I think again, knowing when to push, but knowing when not to push. I think when things aren't working out, or things aren't going to plan, just reminding them that it's not all that bad, and sort of the truth is somewhere between the despondency and the dreams of what they started with. And then on the other side, though, when things are going well, to almost like push them into a negative, or push them negatively in terms of, here's still the embarrassingly poor part of the business. Here is something that is clearly not working. Here is something that is going to implode. Sort of always trying to, I think, calibrate them in the middle and pull them back from despair, pull them back from overconfidence, and that equalizing force, if you will. I think that's another role of the investor.
Something else that I'd be really curious to get your perspective on is your follow-on fund strategy. So again, something that Rory mentioned was, I believe in 2016, when they had some initial happy customers, they were about to go to the US, and I think he said that he received a call or an email from you saying that you were going to triple your pro rata and provided a bunch of introductions to them, to the US investors as well. Again, it's probably something from a founder perspective that isn't really understood, but from an investor perspective, what are things that you sort of look for, or what's your approach to doing follow-on funding into your portfolio companies?
Well, first of all, to take a step back, the normal thing in venture capital is to have like a seed fund that invests in seed rounds, and what that means in practice is that you invest before you know a company's successful, and then you actively choose to not invest after you know a company is successful. So that has never made sense to us at Blackbird, and we've configured our investing such that we want to invest from the beginning. We want to invest before there is a product or revenue. But if a company is successful, we want to keep investing in it. And in Canva's case, we invested $250,000 before they had a product, but we've invested $270 million as they've succeeded to date. And so the idea of the follow-on fund is to allow us to keep investing in a company after that first seed fund has completely exhausted its ability to invest in one particular company. The other part to maybe the story with Rory and Propeller, it was just very clear that the idea of who Propeller served and who was their customer. So in the beginning, it was very oriented around drone service providers. So these people would hire out you if you wanted a drone, you'd hire someone with a drone to come and operate the drone. It used to be a regulatory requirement that someone who is a professional operate the drone. Now you have drones being able to be used by anyone, and anyone being able to fly it on site. And so the sort of customers had switched from this drone service provider to the actual work sites of the quarries or the garbage dumps, or these industrial kind of work site. And Propeller had always also transcended this idea of the drones weren't the interesting thing. It was the way in which people collaborated on a work site and measured how much work was being done. So the actual financial progress of the work site hung on the kind of audit trail that Propeller had created with its product. And so the idea of its customers, the idea of its product, those are all, and the early customers being super happy, all of the metrics of like low churn, high upgrade revenue, bought it for one work site or one quarry, now has it for 12 quarries. These are all the clues that something interesting is happening. And so we absolutely wanted to build our ownership in Propeller. So that was, yes, we wanted to invest. The other thing, though, I would say is you want the company and the entrepreneur to choose you. And the sort of weird thing would have been, hey, we'll lead the round, but you can't go out and talk to anyone else, and you have to say yes within 24 hours. And to me, that is, again, that's a relationship destroying move, not a relationship building move. And so we gave him a term sheet, but we also gave him intros to all the best investors in Silicon Valley, and said, we would love to lead your round, but we'll understand if you make another decision. I'm, as a director of the company, I'm going to excuse myself from the deliberations and choosing of the round investor, but I'm going to give introductions to all the best people I know. Go and speak to them. You'll have greater confidence and greater swagger knowing that you've already got the term sheet in the bag from Blackbird, and you'll begin the round process on a strong foot. And even though that may seem counterintuitive, I think it builds trust. It probably gave us a greater chance of leading the round rather than a smaller chance. And again, I think if you view relationships as the unit of the business, again, the relationship of hopefully many decades that Blackbird has with Propeller, that's what we're trying to improve every day, not the unit being the round of financing and this kind of transactional mindset of trying to win this transaction at the expense of taking away from the relationship over the longer term.
I think one of the most interesting parts of my own podcast research process is getting to speak to a few people that are close to the guest. And, one thing that I found really interesting in speaking to a couple of people, such as Ray Nong, Nick Crocker, and Rory, who I've already mentioned, was them using very similar words to kind of describe your superpower, which is around sort of being brave, courageous, and optimistic. Really curious to sort of understand, obviously that seems to be a trait that sort of you have for yourself. I'm wondering how you are able to sort of encapsulate that or spread that across the rest of the Blackbird team when you sort of look at making investments.
It's also a dynamic thing. And so I think the key to understanding or key to succeeding in investing in Australian startups was actually believing that ambition could grow over time. So I think in 2012, there was almost this lost in translation moment where Americans would come over and the Australian founders at the early stages would be, sort of self-deprecating and deferential and sort of look at their shoes and rather than looking at the sky and the sort of global Silicon Valley chest beating kind of archetype would misinterpret that as a lack of ambition versus sort of, again, seeing it as a dynamic variable where they weren't very ambitious in the beginning and they became very ambitious over time. And the best example is actually Atlassian. And from seeing that up front, knowing that Mike and Scott's original ambition for Atlassian was to earn more salary than they would have got paid in a PwC management consulting graduate salary role, and the ambition to grow over time to what Atlassian is today. So the ambition, increased and exponentially increased, and sort of seeing the potential for seemingly low ambition people, and that unlocking and hatching in a person over time. And so I think seeing it as a dynamic variable, I think the ways in which Blackbird has successfully built relationships is to get people to re-raise their ambition at different steps in the way, to get companies and founders to respond to the success in front of them. I think that, again, that sort of Rocky Balboa moment of like, you can do this. This is truly special. This is the beginning of greatness. And I think, again, it's a dynamic variable where people react to that re-raising of the ambition and it sort of increases over time and success increases over time. And I think we have been very deliberate about doing that with companies we've invested in. We're being very deliberate about doing that within people within the Blackbird StartMate teams. And again, this sort of pushing them to their greatest success, pushing them beyond their mental boundaries in their own mind as to what's possible, knowing that that person is the high potential upside that they have is way, hopefully, I or we can see that 10x upside versus what they can see, which is this artificial, I'm not quite sure, or that's not me kind of thing. So I think unlocking that constantly, sort of probing and testing and re-raising that ambition, and that's what really unlocks the greatness that comes.
Yeah, I think, again, from the outside looking in, one of the really sort of interesting investments was in Zoox, which, traditionally Blackbird was purely investing in software. And I believe that was your first hardware investment. Really curious to kind of go back to the early days or the first meeting with Tim and I guess the decision to invest in Zoox.
It was the definition of a magical idea, and all of those things about the second meeting being better than the first meeting, and the detail and the depth of how the idea had been, the depth of the idea, and how much it had been thought through to the really small details of how the robotaxi would communicate with pedestrians using light and sound, and like that was all in the very first seed round sort of pitch deck of the idea. And so I think Zoox, from the very beginning, had that magical idea that had been thought through and had made so many beautiful kind of decisions around the product or beautiful decisions around the market, like knowing that you should do a robo-taxi service instead of trying to sell the driverless car. So instead of getting, instead of like a Tesla selling for 100 grand and getting 30 grand of gross profit, you operated a taxi that earned, $300,000 of higher margin revenue per year, and hopefully that would be, last 5-7 years in operation. And so just like to that level of detail of beautiful decision, beautiful trade-off, it was always very magical from the beginning. When we met Zoox, it was just Tim at the beginning. This was before he had met Jesse Levinson, who is co-founder and CTO of Zoox. Tim was in Melbourne. He had, after we met originally, he then moved across to Silicon Valley. So the first pitch wasn't, hey, we're raising a seed round pitch. It was sort of like just getting to know him and the idea of Zoox. And so when he moved to Silicon Valley, we kept in touch, provided a bunch of intros, provided a bunch of like basic kind of, here's the game of Silicon Valley, here's preference stock, and here's ESOP and these concepts of how a startup is built. Then he teamed up with once he teamed up with Jesse, once he'd formed the company, he got back in touch and said, hey, we're raising our seed round now. And then that's when ultimately we said yes. It was, as you said, it was an uncomfortable decision because we'd only invested in global software. We were a team of, again, nobodies or hungry, not the proven venture capitalists who had raised a fund on the promise of global software companies. And so to invest in something that was clearly so capital intensive, clearly so illegal. Back in 2014, it was completely illegal to drive a driverless car on public roads. And knowing the billions of dollars of capital that would need to be raised, knowing that they would compete against Tesla and Uber and Google and so on. It was, I think, a brave decision from that standpoint. But I think along each of those lines, you could come up with great reasons why there was a chance, why there was a non-zero chance. And even in the case of Zoox, in that first seed round, we led a $1.3 million total round. Within that round of capital, and within 6 months of the round being wired, they had created a prototype that had demonstrated self-driving ability in the car park of a certain part of Stanford University. So even with that small amount of money, that small amount of time, you could see, again, they'd broken the problem down into these units of progress. And it was just very clear that how the team was coming together, the quality of people, the quality of progress, the speed of progress, all of that, all of those early signs were super, super positive. And so, again, it's to go on that journey. We first invested $500,000 in the seed round. We ended up investing more than $100 million just into Zoox. And so if you view it as that first investment is the exploration. This is a journey worth going on. That's the decision you're making, rather than it's got a majority chance of succeeding or anything like that. I think it's important to open your mind to these types of journeys and endeavors. And if it works out, the first investment will be a tiny, tiny proportion of your total investment. And if it doesn't work out, then you've lost your money, and that's venture capital.
Yeah, I was about to ask, for something like that, as you mentioned, so out of left field from what you normally invested in at the time, it being illegal as well in terms of the solution that they were trying to create. What does that look like internally in terms of, trying to get that through an investment committee, or trying to sort of convey that investment and your conviction of that to your LPs?
I would also put it in the context of, it was 1 year after we raised our first fund, which took us ages to raise. And you've heard the 500 meetings to get to 97 yeses to get to $29 million. So it was in that sense of the difficulty in raising the fund, the story in which we'd raised it on, the sort of, again, hungry, not proven investment professionals of Blackbird at the time. We hadn't, I think, developed the confidence that we have now. We hadn't calibrated all of the things and investment philosophies that are now true at Blackbird. So I think it was in that fragile state such that that's probably what made it dangerous, that we mightn't have invested. However, I would say 10 years on, it might almost seem straightforward for us to make such an investment, which I think, again, knowing all the things that we know about technology companies, knowing all the things that we know about the power law of venture capital, knowing that the first investment will be less than 1% of your total investment if it works out, knowing what is a great idea, knowing what is great ambition. I think hopefully all of those have been institutionalized in the culture of Blackbird and the culture of investment decision making, such that now we would not take very long at all to say yes to a company like Zoox and a founder like Tim.
Yeah, speaking of brave, I believe that Canva was your first or second investment as well after the first close of the fund, which was at a very high valuation as well, which, I think turned away a lot of other investors as well. I guess, were there sort of periods that you were a little bit uncertain in terms of the investment approach that you were taking, or I guess having to kind of field questions from potential LPs that were wondering what you were doing?
As part of our reflection on our investing and the very early stage investing, we looked back and I think less than 40% of our first investments in that first fund didn't have any revenue. So the majority of companies, they had revenue, they had early customers, they had a product, and sort of, again, I would say that was a sign of our lack of confidence as an investment team in our own abilities. And we were always looking for, you've launched your product and you have happy customers, and then we'll invest in your seed round or pre-seed round, which obviously is not true of today's market. So I think investing without a product and without revenue, that was a little bit uncomfortable. I think at the time, Canva, the seed round valuation was $8 million, which the average valuation was probably $2 to $4 million or $2 to $5 million, and that was like unheard of, and they hadn't had a product. And even after the angel round, I think it was nearly a year until they launched the product. They sort of thought they would launch a first version, but the quality of that first product and the quality of that first experience wasn't to the tastes of Mel. And so the team sort of decided not to launch at that point and take all the lessons from the user testing that they'd done and to improve the product for an eventual launch. So it was sort of $8 million for an idea stage startup in 2012 was crazy and reckless. And then to not launch sort of until roughly a year later, that was like a period where people were asking questions and so on. But again, those are all the hallmarks of something interesting, and doing something new is going to have that reaction versus it's almost the opposite now, where you invest in a $40 million pre-money valuation idea stage company now, and it's a proven founder in SaaS, and it's a straightforward decision. It's almost like the lack of questions being asked today is more worrying than the overload of questions being asked, in that type of situation 10 years ago.
And something that you just touched on a little bit earlier was, the power law dynamics that are in place in VC. I guess really curious to sort of understand what role does the power law play in terms of you making particular investment decisions or the way that you kind of think about structuring your portfolio?
It is the law. It's not even that one startup will represent the majority of returns in a particular fund of Blackbird or whomever else. It is that one company will represent the majority of all returns of every single fund of a certain decade. I would say that if you looked at the first decade of this century, Atlassian would have accounted for the majority of all startup returns from that decade. In the last decade, that has been Canva, and Canva is likely to represent the majority of all returns of every single fund of every single year in the second decade. And so it's so extreme and so tied to this outlier success. And so again, the sort of two important points to master from Blackbird's point of view is identifying those companies right at the beginning when they don't have a product. Again, that's so hard and so hard to get right on a consistent basis. But that's the job, is investing everything in building our systems and frameworks and philosophy and so on to identify that company before they have revenue and a product. But the second thing is it's so important to build a great relationship and to continue investing in that company. I would say the reason why Blackbird has 15% of Canva and more than triple the next investor shareholder and is that wonderful relationship that we have been able to build with the company at many different levels and many different levels of Blackbird, and raising and creating those follow-on funds to invest hundreds of millions of dollars just into Canva. That is highly underrated as what accounts for Blackbird's success. So the first piece of identifying and investing at the beginning, I think people mainly talk about that, but the investing hundreds of millions of dollars after it's successful, that is in total response to all returns will be driven by a single company in a particular decade. And the venture capital industry still hasn't quite adjusted its behavior or adjusted its approach. I think people know about the power law. They know that the power law creates these results in their funds such that one company accounts for the majority of returns, but they don't also look outside of that and think just how important that outlier is, or just how important that generational company is to all of the returns of all of the industry in all of a decade.
Speaking of adjustment within VC, I think you mentioned this on another podcast that I listened to as well, but VC funds have traditionally operated, especially in Australia, in a very particular way. Small number of partners, a small operational team overall, and that's essentially the way that things have played out. And I think that you've also mentioned that, for a really long time, you and Rick wanted to build the Craigslist of VCs, so having a very small company going on to make these investments. Over the last few years, it's been incredible to see that Blackbird has grown from 4 to about 60 people. I'm curious to know what led to that inflection point or that sort of change in thinking and approach, and where do you sort of see the future of Blackbird going?
I think the original vision was to do with our own lack of confidence and our own inability as first-time managers or company builders, and the inability to see the joy of building a great company, building a great culture, seeing the careers of people that you hire into rise up through the organization, the sense of pride that you get as you see those people succeed. There's just nothing better in business than seeing that up close. And so I think we just didn't know about it, and we were naive and closed-minded. And I think very quickly learning from the companies that we had invested in, and seeing their own rise, and seeing how they built their own great cultures, and seeing how they had built these great companies are almost as beautiful as great products. And I think seeing that awoken us to our naivety, and we wanted to build Blackbird with the same love and the same culture, the same high standards of company building as the companies that we invested in. The other thing I would say is that what we hoped would be true came true. We hoped that Australia and New Zealand would produce these global champion companies, these generational businesses that go on to be the most valuable companies in the world. And the startup ecosystem in 2012 is a small fraction of what the startup ecosystem is today. And so what that means, I think, in two ways. One is that you need to create an organization that's bigger in terms of people, but also bigger in terms of product leverage. Like, I think to meet every company and make a good decision at the beginning, you need to kind of probably meet 2,000 founders per year at the moment across Australia and New Zealand. And so you can't do that just through increased people. You have to do that through programs like StartMate or Giants and these kinds of product approaches to solving those problems. And so there's the making a good decision at the beginning and taking a product mindset to that. There's also helping companies, and I would say helping companies, people always talk about adding value and so on, but breaking that problem down into two discrete components. I would say one is the helping the journey of a founder to becoming a great CEO. As I said, it's so unlikely that someone with no business experience would make the leap from founder to CEO of thousands of people and biggest company in Australia. And there's so many moments along the way in which they need to learn and master these different skills and abilities. So I think helping from founder to CEO in that journey, and that's a whole set of programs and products that we hope to build there. And then in a software context, nearly every cent and every dollar is used to hire people. And the people you hire will determine the probability of success. So if you hire great people, the probability of the company achieving its goals goes way up. So I think helping build that team, and traditionally venture capitalists have been, we'll help you hire the senior person, or we'll maintain a list of executive recruiters that we'll refer you to, and that sort of lame approach or lame ambition to helping build a team, versus would it be possible for Blackbird to account for 20% of all team members in a company? So not just in the early stages, so two of the first 10 employees or 20 of the first 100 employees, but Canva, who are nearly 3,000 people and might be hiring thousands more this year, could you help a company like Canva hire hundreds of people? And again, we're not doing that now, but we're sort of making the first inroads in helping at scale build great teams and hire great people that they would not normally have found via a traditional posted job on LinkedIn or Seek or wherever it might be. So help build a great team, help with the founder to CEO journey, and then build these products and programs to meet thousands of people and potentially tens of thousands of people. You're going to have to lift the number of team members, but hopefully the number of team members don't. If the ecosystem 10x's, the Blackbird team will not 10x. It will hopefully 5x or 3x or 2x or whatever the appropriate ratio might be. So I think helping, being accountable at scale, and to me, building Blackbird with the same love and care and the same nurturing of the same great cultures that we see in the best companies that we've invested in, that's the challenge in the next decade.
Diving into that a little bit deeper, when you talk about building up that ambition and again, from the outside looking in, absolutely incredible the number of programs that both StartMate and Blackbird are launching. Do you have any sort of systems or frameworks or processes that you go through internally to identify these particular initiatives or approaches, or I guess to expose the broader team of 60 people now to kind of raise their ambition?
I think it's probably more environment setting or creating the right environment for that ambition to be unleashed, and as the glimmers of ambition sort of bubble up, to double down on it, to push the ambition to greater heights. I think the best example is the StartMate Fellowship, of what started as a fellowship for a handful of people and was really just an experiment around could we sort of translate corporate Australia into a startup role like a growth marketer or a product manager. But it wasn't particularly, it was sort of a very unassuming starting point. And then only when Sophia joined StartMate and decided to make it about the Women's Fellowship and decided to raise the ambition of 100 people per cohort and started to demonstrate that instead of a handful of people, StartMate placed hundreds of people into startups in Australia and New Zealand last year. Hopefully the fellowship will place thousands of people into startups in Australia and New Zealand this year. And I think the ambition, again, if you have the ultimate, can we account for 20% of all hires of all startups in Australia and New Zealand? If hopefully to know that if the programs and the ideas start to show initial success, we're very willing to invest and help those teams grow to, maybe even the fellowship has more employees than the sort of regular Blackbird portion in a couple of years to sort of fully express the ambition to take it to its hopefully highest conclusion in terms of the impact it makes on a startup ecosystem. Like, I guess, nurturing that, supporting that within the Blackbird team. And it's probably not me or the leaders of Blackbird going to come up with those ideas, but hopefully the beauty comes if you create the great environment for those people to launch those successful initiatives within the company. That's where the magic happens.
For the benefit of the listeners who maybe don't have the good fortune of being part of Blackbird or StartMate to necessarily have that environment, do you have any advice on how founders can create that type of environment for themselves?
I think obviously learning from others. Again, like the whole idea of Blackbird is founders helping founders, and I think people learn the most from other people, either building alongside them or one step ahead. So that's always a source of, and in the early days, the cohort of the best early stage startups are still really, really accessible when they're modestly successful versus when they're very successful, like Atlassian or Afterpay or Canva or so on. So it's actually quite easy to get mentorship from other founders at a similar stage or one step ahead in the beginning. So that, I would say, is The meta skill is surrounding yourself again with great people and learning from their own experiences and getting personalized feedback on things that you're trying and seeing succeed or fail and getting their feedback on those specific initiatives rather than kind of general headlines as to what to do. I think people who think about culture deeply and think about there's sort of two parts to building a great company. There's building a great product and then building the great company. And I think the forward predictor of great success is that people who think about both quite early on in their journeys. Obviously, in the early days, you're just kind of trying to figure out whether you're doing something that people care about, and building a great product is naturally the vast majority of what you're thinking about. However, the earlier that sense of building a great company enters into the dialogue of the company or enters into the mind of the founders, that's always like a forward predictor of great success. And I would say there's no time too early to think about how you're going to build a great company and what you stand for. And the other thing is what you stand for. Whatever you come up with, you should be able to invert it, and for that inversion to be a completely reasonable point of view. Like as we've been talking about, the hungry, not the proven. Investing in the proven is a completely reasonable proposition, and people, in fact, even publicly say that they love to invest in repeat founders and so on. So it's a reasonable thing to do, and so something like the hungry, not the proven, is a good test of that because it makes sense in whether you take the hungry side or you take the proven side. Versus interestingly, Enron, one of Enron's values was integrity. So you can't invert integrity. Integrity is like table stakes. You're never going to get a company that says where our culture is the opposite of integrity. And so again, that's a flimsy value, or that's a flimsy thing to build your culture on, because it doesn't make sense on the in the opposite way. And so when you do come up with those values that are personal to you and the company, make sure you invert them, make sure that they make sense in an opposite way.
Final question from me, Nikki, I promise. I think one of the things that I absolutely loved, as I kind of mentioned, was Sam's talk at Sunrise, kind of explaining the values process. And I guess during my time at AWS as well, the 14 leadership principles guide so much of everyday conversation, how the company hires and all of those sort of things as well. But I guess articulating or getting to a point where you can really sort of encapsulate your values into words that you can then sort of share with others can be a difficult process. Again, for any founders, do you have any advice or resources that you think can help them articulate what their values are?
There's lots of good folks who run workshops on this. There's you look for the Netflix culture deck, look at through Stripe's operating principles, look for other companies' cultural values. There's lots of blogs or podcasts as to how they were set up. So sort of, I think taking the time, in terms of taking the time, lots of people might think, oh, it's a bit too squishy, or it's a bit too early for me to think about that. The way I would think about it is, people think of software as naturally scalable and naturally what's going to create a great business. But language, at a general level, is the ultimate scalable thing of how it brings humans together, how it gets people to work together. And I would just think of taking the time to write down your cultural values or write down your operating principles. You're writing the software for how the team works together. You're writing the software that is going to attract the best team to come and work for you. And it's this ultimate software that gets a company to move really quickly and gets a company to build something special, versus not doing that. It's like inviting chaos unless you have this kind of structured software, scalable language building blocks of culture. And that's ultimately what lets you not have to say things over and over again, what lets people make great decisions, because they have these guiding forces as to frameworks as to how to make a choice or not make a choice. It's the ultimate scalable way to grow a company.
On that note, and speaking of taking the time, Nikki, thank you so much for taking the time to come on the podcast and for sharing your experience and insights. It's been absolutely fantastic. For those people that want to find out more about you, about Blackbird, or about the media fellowships, what's the best way for them to do that?
follow me on Twitter. Send me an email at niki@blackbird.vc. Check out Blackbird or Startmate, the websites, and hopefully that's a good starting point.
Perfect. I will make sure all those links are in the show notes at startupplaybook.co after this episode. Niki, once again, thank you so much for coming on. It's been a pleasure.
Thank you so much for having me.
Cheers. Thanks for listening to episode 159 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe on whatever platform it is that you listen or watch the podcast. Thanks for tuning in, and I'll see you next week.